When we small business owners have uncertainty about our businesses, it creates fear and overwhelm. With fear and overwhelm comes a loss of control. We have no clarity about the future. We fight fires every single day, and we use gut feel to make business decisions. We stay up nights worrying about whether or not we're going to make payroll. We stay up nights worrying about whether or not we're going to get new business, and if we get new business, are we going to do it profitably? We stay up nights worrying about whether or not we can pay our personal bills and what we're going to tell our spouses when we can't. We stay up nights worrying about what could possibly go wrong next, and we fear the embarrassment, emotional, and economic loss associated with total and complete failure. On the other hand, when you have control over your business, you have clarity about the future. You know what tomorrow will bring, and if tomorrow takes a different turn, you know how to handle it. You have the right tools and the right information to make the right business decisions. And you have all the contingencies covered. And as a result, you're able to enjoy more profit and income, pay all of your bills, have no more challenging discussions with your spouse about getting another job, and at the same time, increase the value of your business. In short, you have a business that works. My name is Michael Barbarita from Next Step CFO, and at Next Step CFO, we are a contracted Chief Financial Officer services firm. And we are providing services and producing information products that give clarity and control to small business owners, helping them make the right business decisions that lead to multiple six figures in profit and income and seven figures in business value. With over 30 years of experience in actually owning retail, manufacturing, and service companies, I truly understand the risks and opportunities of business ownership. And over the last 10 years, I've been providing clarity to small business owners through business and cash flow forecasting, key performance indicators or metrics, and business ownership experience. In this short video, and the free short videos that I put together for you available for download, I'm going to show you how to gain more clarity and control over your business, as well as helping you make better business decisions. I basically answer frequently asked questions by business owners, as well as questions that business owners should ask. At the end of this video, I'm going to show you how to get those other free videos. So sit back and enjoy.
Without a doubt, one of the most misunderstood concepts by business owners is profit does not equal cash. From now on, may this concept burn in your memory. Net profit does not equal cash. Hello everyone, my name is Michael Barbarita from Next Step CFO, where we empower the business owner with information and analysis that leads to business success. Today I want to clarify this commonly confusing concept. Have you ever made any of these statements? Well, most of my clients did. Business owners who watch their profit and loss statement regularly think they are also simultaneously watching their cash flow. Nothing could be further from the truth. Managing the P&L and managing cash flow are two separate and distinct functions. Before we look at the next slide, let's just focus on the first bullet on this particular slide. We are making money, but there is no cash. What I'm going to show you is, in fact, that net profit does not equal cash. And in this slide, I have a simplified profit and cash flow example. On the left side is the P&L. And note, you have sales of $1.2 million. You have cost of goods sold of $800,000, leaving a gross profit of $400,000. Then when you deduct $200,000 for SG&A, which is selling, general, and administrative expenses, you are left with a net income of $200,000. That $200,000 net income is carried over to the cash flow statement. Let me explain the simplified version of the cash flow statement. First of all, this is not a traditional looking format of a cash flow statement. This is a cash flow statement under generally accepted accounting principles, formerly named a sources and uses of cash statement. But before you run out the door thinking that I'm going to bend your brain backwards with accounting jargon, I ask that you give me a little over 2 minutes to explain this because that's all I need. This type of cash flow statement compares balance sheet account balances from the beginning of the period against the end of the period. In this case, we are talking about the period being a fiscal year. So we're comparing the balance sheet account balances at the beginning of the period with the balance sheet account balances at the end of the period. By the way, the brackets around the numbers represent a negative impact on cash flow. This cash flow statement starts out with net income, which, as we learned from the P&L on the left side, is in fact $200,000, and that is obviously a source of cash and reflects positively toward cash flow. Added to net income is a non-cash expense called depreciation. But this adjusted net income is not the whole cash story as is commonly thought by business owners, because the very next line item shows an increase in accounts receivable. When the change in accounts receivable balances increase, this is a use of cash because money is being tied up in receivables. Now, on the other hand, it would be a source of cash if the change in accounts receivable came down, because that means you work down your receivables, receiving more cash. In this example, the change in accounts receivable increased, causing a negative impact on cash flow. The next change in a balance sheet account that occurred is inventory. In this example, inventory increased. The increase of inventory is also a use of cash, because you're purchasing more inventory using cash, and therefore has a negative impact on cash flow. The next line item is a decrease in equipment. This indicates that equipment was probably sold. Well, when you sell equipment and get the cash, that would represent a source of cash and therefore a positive impact on cash flow. The next line item is an increase in accounts payable. An increase in accounts payable indicates that you're delaying payments to the trade, and that's also a source of cash because you're not giving it to the trade, you're keeping it. The final line item in this example is an increase in the line of credit, which is an obvious source of cash because you're taking money from a line of credit at the bank and putting it in your company bank account. Although this company made a $200,000 net profit, the company lost $90,000 in cash in this particular year. Upon a quick analysis of this cash flow statement, the cash tied up in accounts receivable was probably the impetus that led to the $90,000 cash reduction. Now, if the beginning cash balance in this particular company was over $90,000, they still have cash left on the balance sheet. But unfortunately, the beginning cash balance was $50,000, and so when you take into consideration that the company lost $90,000 in cash during this period, that's probably why their credit line increased. In closing, a business owner who manages their business solely on what the P&L says will make bad business decisions. Any business owner who manages their business solely on what their cash flow statement says will also make bad business decisions. It is the business owner who runs their business on the basis of both of these financial statements who will maximize both profits and cash flow. If you have any questions, please feel free to contact me. My contact information is on this final slide. Thank you for listening, and may the road to success rise up to meet you.
Thank you for watching this video. If you like this video, I have 19 other short, free videos just like it available for download. All you need to do is go to www.nextstepcfo.net, click on the link that says free videos, and we'll download those to you immediately. I look forward to helping you.